an emergency announcement out of the Fed this year in 2025, and what we can expect for you, your money, your benefits, and what else you need to know. I have all the details for you here in the video. Let's get into it and discuss what's going on. All right, 2025 has been a very interesting year so far. A lot of big things have been happening, and we know a whole lot more is coming. However, we also have this other situation that we're dealing with right now where the Fed is likely to come out with an emergency announcement outside of their regular meetings, and that's exactly what I want to focus on because at the end of the day, it's going to impact all of us across the entire country, our money, our benefits, our finances, and it's also going to impact some other things. And I want to bring to your attention why we would want to watch for this. When we see this type of announcement coming out of the Fed, this emergency meeting, and oh my, we've got this announcement for you. When we see this is going to be a major sign of what they're seeing and what it may mean for all of us going forward shortly thereafter. Okay, let's quickly paint the picture of what's happening here. And again, you kind of know the situation, but for several years, we've been dealing with a couple different things. Number one, high inflation, right? Inflation has come down according to what they've told us, and we're not really feeling that relief. Therefore, many people are still struggling financially, massively, and that's kind of the situation. Again, you've heard me talk about this so many times before in other videos. When it comes to that, you've seen so many reports that are out there. Well, we've also been dealing with very high interest rates, right? The Federal Reserve started raising interest rates years ago to try to get ahead of all this inflation and to bring the inflation down by raising interest rates, and they've been holding interest rates very high for also a very long time. In fact, the very first cuts to interest rates was back in September of 2024, the first interest rates that they had in about a 4-year stretch of time, right? So my point is, when interest rates are very high, this makes it very tough financially for a lot of people, you and me, as well as businesses, small, medium, and large. Basically, everybody's out there is struggling financially as a result of high interest rates. Well, then the Federal Reserve basically comes out every 6 weeks and they have their FOMC meeting, right? I've talked about this before in other videos, but it's every 6 weeks they have these meetings. Now, here's the interesting part about this. We want to continue watching their interest rate policy. What are they going to continue doing going forward? Are they going to pause more? Are they going to cut interest rates? Are they going to raise interest rates? What are they going to do? Well, when we're seeing some of this inflation data that's coming out that's maybe not very good, as in it's not really coming down, that is making the Federal Reserve hesitant to lower interest rates. But the longer that they keep interest rates elevated, it just makes it more and more difficult financially for, again, consumers, you and me, and everybody else out there, as well as all the businesses. It just makes it really tough for everybody when interest rates are so incredibly high, because if we're borrowing any money, the interest rates on that are very high, and it just makes it really tough. Again, we know what we're talking about here, right? Like, just look at interest rates on credit cards right now. That's not a fun one, right? I hope you're not floating any balances. It's not a very fun situation. But when the Federal Reserve keeps these interest rates high like this, what happens is, like I've been talking about before in other videos, which is it's tough on the economy. The economy is feeling the effects of these high interest rates, and it cannot be sustainable for all that long. But the Federal Reserve just keeps these interest rates very high. When this happens like this, eventually what we're going to see, and we're already starting to see that, we have been for a while, is that this erosion in the overall economy. Economy is not doing great, and the whole overall performance and the productivity of the overall economy and GDP starts to wane. In other words, not doing that great, starts to slow down. When we see that happening, that simply means that we are contracting. The economy is contracting. So basically what's happening is that when the Federal Reserve is just holding interest rates high, it's making it really tough. The economy is contracting, it's slowing down, and we're getting closer and closer to falling into this big old recession, right? Well, here's the situation. When we see a major kind of drop in productivity and the overall economy and GDP, what's likely going to happen is that the Federal Reserve eventually will come out outside of one of their FOMC meetings and say, hey, guess what? We're going to do an emergency rate cut now. What would that signal to all of us? Well, let me point out really quickly what it means. When the Federal Reserve comes in and aggressively cuts interest rates, what that's telling us and what that's signaling to all of us is that, hey, they see something on the horizon or that we're currently dealing with right now that may not be all that widespread, that we're not, experiencing massively at the moment, is when they cut these interest rates aggressively, they think, hey, this is an ugly picture. The economy is not doing great, and we need to get ahead of it, and we need to cut interest rates aggressively now to avoid even more digging of the hole in the overall economy, if you kind of get the metaphor that I'm talking about, right? So as a result, they're likely going to be coming out. And again, it could be in a week. I mean, I don't think it's going to be in a week. I'm just simply saying, okay, at some point this year, we're likely going to see some type of meeting where they come in and say, hey, we're going to hold an emergency meeting real quick. And then they come in and say, just because of market conditions and market vectors and whatever economy, we're going to cut the interest rate by 50 basis points or 75 basis points, whatever it happens to be. And that is the signal to all of us that, hey, they see something's not good here. It's unraveling quickly. Get ready. We're going down, right? And that's when the economy is basically on the cusp of something real big, mostly not positive and mostly recessionary and mostly contractionary, right? So when we see this type of thing, and it's likely going to happen. And here's the thing. If we roll over and the economy starts heading down real super fast, then the Federal Reserve will certainly come out in an emergency meeting outside of their regular FOMC meetings and issue some type of rate cut as an emergency, like, hey, we got to cut interest rates right away here to help this out and to help spur and stimulate the overall economy. Remember, the purpose of the Federal Reserve basically cutting interest rates, when the economy is softening and weakening up, what they do is they cut interest rates. The purpose of that is now, hey, look at that. Interest rates have come down. It makes it easier to borrow money. When it's easier to borrow money, more of us have the ability to credit or the ability to borrow money or get access to credit. And then when we have that, we can move forward and borrow money. Again, us individually on credit lines or credit cards, or businesses can borrow money. It makes it easier and cheaper to get access to that money, and then we go out and spend the money, and that stimulates the overall economy. Now, here's another thing as well that I've talked about that I do want to discuss for a minute here, which is when we see the overall economy weakening, what happens at that time too? We usually see hundreds of billions or trillions of dollars appropriated in the form of stimulus packages, a lot of times also containing stimulus checks, not every single time, but a lot of times they do, and then they approve those and they push those out, and again, to stimulate the overall economy. So we're basically on this cusp right now where a lot of things are diverging. There's a lot of things that are coming together. We've seen some of them so far now in 2025. We're only a few months in at this point, but my point is we've seen a lot of these things happening, and with that, we're like right there. I mean, we're like right there. When we start to see all of this unraveling, it's going to be kind of interesting to watch this whole thing play out. When you see the Federal Reserve come together with one of these meetings, which, by the way, I will certainly bring that to your attention, but aside from their FOMC meeting or even during their FOMC meetings every 6 weeks, if they would come together and cut interest rates aggressively, which, by the way, as of now, they're still only pricing in one interest rate cut this year. Depends on when that's going to happen. Sometimes people suggest it's going to be over the summer. Some people are suggesting it's going to be in October or later in the year. We'll see when that actually happens, but whether it's in one of the regular meetings or outside of that as just a spontaneous, hey, we're going to come together and announce in a meeting, when we see that big interest rate cut come in like that, that's going to be the signal that, hey, things are not good. Get ready. They're about to, unleash stimulus at that point. It's not necessarily a guarantee, but that's kind of the playbook that they do every single time. And that's kind of what we need to continue watching for. So I would fully expect one of these announcements at least at some point this year. But we'll have to see when exactly that hits. But again, it's all going to be predicated on the overall health of the economy, what happens here, and what we expect and what we can kind of continue to see going forward. And the weakening of the data that comes out. Remember, the Federal Reserve is data dependent, right? They look at all the data that comes out and their decisions are data dependent. So it's basically lagging. Every decision that they make is kind of lagging. Like, oh, we saw the indicators, we saw the inflation data, we saw the unemployment data, we saw the labor reports, we saw the PPI, we saw all these different economic data points that come out, and we're adjusting our interest rate policy because of that, right? So it's always lagging. But anyway, does that kind of make sense as far as what we're kind of watching for and what we can kind of expect and the warning signs behind one of these announcements? So anyway, I'll continue to keep you posted on that. Again, I'm watching the headlines every single day. I want to continue to keep you posted with what's going on and just continue to do whatever I can to represent you, advocate for you, and help you out in any way that I possibly can. Grab as much money, take advantage of benefits, and anything to maximize your income or your monthly benefit. Again, I'm here for you. If I can ask a huge favor of you, number one, please make sure to subscribe to the channel. It's totally free to do so. If you're new or if you haven't done so yet, right down below the video, there's a subscribe button. Thank you so much. I truly do appreciate your support. Thanks for being part of the community. Also, if you can share this video with your friends on my social media, or if you can just think of 1 or 2 people that benefit from this information, feel free to share this video with them. Thank you. Really, really appreciate it. Otherwise, check out the thousands and thousands of videos here on the channel in the video library, or down below in the description or the top of the comment section. I've hand-selected some videos for you there. Check those out. Or right now, popping up on your screen as well. You'll see some videos there. Thank you so much. Please have a nice day. Hope this helps you, and I'll catch you again later in the next